Hi there, welcome to Kneppy Invest and welcome to another technical update video. I have come off a night shift, and as soon as I finished my night shift, I went for a run. I did a 10K run, the first run of that magnitude for 5 months. I was injured in February, didn't run for 5 months, and I started running a few weeks ago. And this particular 10K run took me an hour and a half. Yes, that is slow. But the most important thing is when you are recovering from an injury is to get the kilometers or the miles into your legs. Doesn't matter how slow you're running. That's not the point. It's just making sure your legs remember how to run, because they've been lazy the last 5 months. So the whole point of me doing this 10K run was not speed. It was just to get those kilometers and to make sure I am actually over this injury. Hip flexors are buggers. They take. It took a long time for me to get over this injury, and everything's feeling fine. Although my legs are tired because not used to running 10 kilometers. So, and I've actually recording this video about 10 minutes after I finished that run. I'm not sure if that is a crazy thing to do, but I decided why not just do this video straight away. Anyway, so time is currently 10 or just past 10 a.m. Of course, market's not open today. I do wish the market was open 24/7, but that's just me being crazy. And we had an interesting week in the markets, particularly the last few days. A little bit of weak economic news in the United States has pushed their market down and has really increased the negative sentiment, massively increased the negative, well, maybe not massively, because I do find X or Twitter, whatever we want to call it these days, is or does tend to be quite pessimistic. And whenever something can fuel, any sort of economic release can fuel that pessimism, you're going to see it. So a lot of pessimism on Twitter. And I do think that's probably justified, because the economic indicators we did see released in the last few days of the week were important ones. The PMI, employment and unemployment, two really important factors. In fact, the unemployment, no, we'll look at this now. In fact, you can see it through TradingView. We'll just go to the Nasdaq. We'll just zoom in here. So the unemployment, here it is. Yeah. So they released the non-farmer payrolls, and that was significantly lower. So this is new employment, that sort of thing, new jobs. It was significantly lower, 114,000 compared to forecast 175,000, previous 179,000. So that was a little bit of concern. But the unemployment rate was forecast to be at 4.1, came in at 4.3. And that actually did create a bit of a buzz. And in fact, I haven't opened up Twitter. Maybe I should. I wonder if I bookmarked it. I'm hoping I did bookmark it. Let's have a look. No, I didn't bookmark it. Well, maybe I did. No, yeah, I did. Yeah, okay, yeah. I sort of did. They're talking about the SARM rule. There is this SARM recession rule, and some people say it was triggered on the Friday because of the unemployment rate. Now, I'm not an expert in the SARM rule, because there was a bit of toing and froing. Some saying it was triggered. In fact, bar chart said, I think it was the Bank of America mentioned it was triggered last night or on Friday, whatever it is. And here's another one from Stephen Kukulas. I think he's Australian, because he's mentioned the RBA. Utterly dreadful US labor market data. Very bad news. The Fed has erred, or at least needs to go 50 in September. So very interesting. This is the one. Michael A. Arrowitz. So I did bookmark this one. So this is looking at unemployment and sort of the link to recessions. So what he was trying to point out, and a lot of people didn't understand this, because there was a lot of debating whether this particular measure is forward-looking or backward-looking or lagging, lagging indicator. That's what they was talking about. But the most important thing here is when unemployment starts to rise is an indication of the potential that they've moved into a recession. This is the United States. It has happened time and time again. So if you go back through the last 70 years, every single time unemployment starts to rise, recession, 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 recession. Always happens. Always happens. In the past 7 years, every single time you start to see unemployment rising, that is an indication that the country is in a recession. And that's why I do focus on unemployment. It's very important. If you see unemployment rising, that is really bad news for the economy. It just makes sense because there's less people employed, less people spending money. It's going to be a significant drag on the economy. But a lot of people are just debating, well, it's a lagging indicator. It's irrelevant. It's just that unemployment is starting to rise. So there is a greater chance that America is moving into recession. This summer, I did learn about it. I did learn about it quite a few years ago, but I just can't remember. It has something to do with unemployment and the rate of increase of unemployment. I think was important. Let's actually Google it right now. SARM rule, because the person who created it is still alive, so it's not that old. So the SARM rule says a recession is underway when the 3-month average of the unemployment rate jumps by more than half a percentage point in a year. But there was a little bit of debate about this because was it exactly 0.5% or was it just below 0.5% or just above 0.5%? So that's the SARM rule. When was it created? It wasn't created that long ago, I don't think. I remember, 2019. SARM rule was published in the St. Louis Reserve Bank system in October 2019. Yeah, so it's not that old. Yeah, I did actually hear the person who created this. What was her name? Her name is Claudia Sam. And I remember listening to her, and she wasn't that old. No, she's not that old at all. Potentially, I'm older than her. She got her degree in economics in only 1998. Yeah. So anyway, that's the SARM rule. Don't know a lot about it, but I did read about it a few years ago. So when it wouldn't have been that long after actually it first was developed. Anyway, so big question is, are we in a recession? David Rosenberg says yes. The SARM rule triggered the recession call today, and the committee that decides whether the United States is in a recession will look at this. They will look at the unemployment, and this could be the catalyst for them saying the United States is in a recession because they don't look at the technical definition of 2 negative quarters of GDP negative growth. They don't look at that because this happened, was it 2 years ago? They had 2 quarters of negative GDP growth, no recession, because unemployment was not growing, was at fairly low levels, and now maybe this could be the trigger for United States being in a recession. So we're a little bit different. We do use the technical definition, and in my opinion, we should be using the GDP per capita, not just GDP, because it's how do I say this? It can be and has been manipulated by the governments by increasing immigration. And if you increase immigration, more than likely GDP is going to grow because the population's grown. So a better, I think, indicator of whether we're in a recession or not is GDP per capita. Has that fallen? And it is falling, and that's why I do think we're actually in a recession right now. Okay. So I've gone a little bit of a tangent. I wasn't actually going to do this, but because this is a technical update video, but it does affect the market. It does affect sentiment, and that's exactly what happened in the last 2 trading days of the week in the United States. This bad economic news has really shifted sentiment quite drastically. Now, will it last for a long time? Is this the start of a bear market? We're in a correction, or well, the Nasdaq's in a correction. It's gone down 10%. So what's the definition of a correction? I believe it is 10%. Correction, equity markets. Pretty sure it's 10%. There it is. Nasdaq answers correction. What is a correction in the equity market? 10%. I think the next one is 20%. What's the one after correction? I forget. Correction. Bear market. Definition of bear market. Is that 20%? Definition. Can't spell definition. Bear market happens when a broad market index falls by 20% or more from its most recent high. So the Nasdaq is already half there to being down to 20%. And this is just a byproduct of the Nasdaq. I just think the Nasdaq is so fickle. It just, and I'm going to show you one individual company's chart, Snapchat, and you just look at this chart and you just, you just, you just think it's crazy. I just looked at it and went, it's just nuts. The market over there is nuts. The investors over there are just crazy. And I come to that opinion just by looking at this one chart. Anyway, I'm rambling on a little bit, but let's start off with the Australian markets, because if you just look at the weekly chart, an okay week, relatively weak. In fact, the XJO was up for the week. XJO for the week was up 0.28%. So we'll be down significantly on Monday. I think that's almost guaranteed. And in fact, the 1 day or the 1 week candlestick actually does look pretty weak. So everyone was giving themselves high fives, middle of the week, got to all-time highs. I listened to a few podcasts that were released on Thursday, and everyone's giving high fives, markets at record highs, and then, of course, the bad news hits the fan, and I didn't say the magic word there because I don't want to swear on this channel, but we all know what I meant. So things can change quite rapidly, and this 1 week candlestick is actually fairly bearish candlestick as well. But in saying all that, when you look at the long-term trend, it's still up. I wouldn't be surprised to see if we do move into a bit of a bear market, if we do see a little bit of selling, maybe recession, I wouldn't be surprised to see the SGO fall to 6,400, 6,000, or maybe 6,700, which is not that much of a drop. So we are talking about maybe a 15% drop. I think if a worst case scenario, I wouldn't be surprised to see us drop 20, 30% in the absolute worst case scenario. We go into a serious recession. 50% drop is a possibility, just a possibility. And then, of course, some people will counter. If that's going to happen, the governments will start printing money end over fist. But can they do that? Because inflation. If inflation remains a little bit sticky, they can't do that. That's the problem with stagflation. So we have to keep an eye on inflation as well, and we want inflation to fall. So if we do see inflation fall, that gives the central banks that very important weapon, interest rates, decrease interest rates, and that should help with any recession. That should fuel some investments, that sort of thing. That's all. And spending, consumer spending. More money is in people's pockets, particularly homeowners or mortgage owners, because I'm a homeowner and I don't have a mortgage, so I won't put any more money into my pocket. But anyway, so no reason to panic just yet, in my opinion, but it can be prudent to decrease your risk, maybe to increase your cash. It all depends on your risk tolerance. Some people like to stay fully invested because they believe you can't time the markets. That's okay too, because over time the markets will rise. But if you do know yourself, and you know that if the markets do drop 30% or so, and you're going to feel really horrible if it does that, you can take or decrease your risk. Go a little bit more to cash. It's all up to you. I won't tell you what I'm doing, but I have a plan, and probably that's the most important thing. Have a plan. And maybe stick to that plan, but always be flexible. Change your plans if things start to change in the other direction. So that's the XJO. And if you have a look at the daily chart for the XJO, of course, the last day was bad, down 1 or 2.11%. It's really interesting because on the Thursday, the XJO got very close to the top of the trading channel. It was only a few, maybe 50 points off, which means there's a high risk that there is not going to be much of more of an increase, just because the XJO has been trading in this range for 15 years, and only once has it got above that range, and that was back in August 2021, and only got above it for a few days, 5 days, and then fell. In fact, it fell from just above it all the way to almost near it in about 1 year. So that's definitely something that could happen with us right now over the next year. Don't know. It's the future. It's the future, and no one knows the future unless you have a time machine. And if you do have a time machine, can you not tell everyone about it? Just tell me, and we can make a lot of money. Sort of like that guy on Back to the Future who stole the almanac, sporting almanac from Marty. What was his name? What was his name? Not Bud. Bad guy. Back to Future 2. What was his name? Biff. Biff. How can I? Oh, Biff, Bud, Biff. They're sort of the same, Biff and Bud. Okay. Yeah. I'm kidding. Am I? If someone did develop a time machine and they only told me, would I do that? Actually, I wouldn't do the sport almanac. I'll just go and look at what companies did well. Anyway, let's go to the XSO, and this would be weaker. And yeah, this is less exciting. Down 2.1% for the day, and for the week, it was actually up 0.9%. So actually a pretty good week for the small caps. But when you do look at the weekly chart, no reason to get excited about the small caps just yet. Remember, there was all this happiness in the small cap land about the huge, or what they call the big rotation from the big companies into small caps. That didn't really translate to Australia. It was only relevant in the United States. And even that thematic has significantly shifted in the past week, well, the past 2 days. So the XSO looks pretty, well, it's always looked up really compared to some of the other indices. Nasdaq, it's in a correction, down 10%. Can you believe it? And that 10% is in 3 weeks. Yeah, it's gone from 20,700 to 18,400. So that is, yeah, more than 10% correction. 20,000, what was it the high? 20,700, so it has to fall 2,000, just above 2,000, which means 18,600. And it is right now 18,400. Yeah, so the Nasdaq's in a correction. Yeah, absolutely. But it's been in correction, it goes into corrections lots of times. The main thing is corrections happen all the time. Bear markets don't happen all that often. Looks like there's a bear market here, though. Yeah, bear markets don't happen all that often. Was this a bear market? Let's have a look. Got to a high in 17,000, so bear market will be 13,600. And yeah, it got into as low as 10,600. This was a bear market. Yeah, so bear markets, corrections happen all the time. Bear markets don't happen all that often. All right, so 3 down weeks for the Nasdaq and 2 big down days to end the week, and that really put a bad end to the week. So down 2.44% on the Thursday and a further 2.4% on Friday. And it's not, when you look at the daily chart, not looking absolutely negative just yet, because we've had these dips before. So this could be a buy the dip situation, but I'm a little bit more bearish than I was just 3 days ago. And the Russell 3000 or Russell 2000, a lot of excitement. Looks like it was breaking out. This was back in the middle of July. Looks like it was breaking out, and 2 really bad days in a row. Down 3% on Thursday and down another 3.5%. So even worse than the Nasdaq on Friday, and an absolutely horrendous week for the Russell 2000. Down, I have a feeling it was down 6%. So 6.4%. 6.7% for the week. And this potential breakout for small caps, and those small caps, or those happy small cap fund managers, are not happy anymore. They're probably crying in their cereal. Well, I don't know why I said cereal, but they're probably crying. Well, probably not crying because they're really rich, and well, having a lot of money does not mean you're happy. If I had a lot of money, I would be happy, but everyone's different. So bad week for small caps in the United States, down 6.7%. That's huge. And of course, Dow Jones had also bad week, not as bad as the Russell 2000, only down 2.1%. What was the Nasdaq? That was down 3.1%. So Dow Jones, the best for the week. In fact, if you look at the weekly Dow Jones, it's just a little blip. Nothing to be worried at all at this point in time. All right, elsewhere, Nikkei, horrendous. Nikkei, bad week. In fact, acceleration in the bad weeks. So 2 weeks ago, down 3.8%. Last week, down 3.5%. And this particular week, down 8.7%. It's almost a correction in 1 week, almost. But when you do look at the weekly chart, still in an uptrend. This is just a little bit of a correction. Well, yeah, it's a correction because it's down by more than 10%. Look at the daily chart though, and I'd say this looks in, that does not look good the last 2 days. That would be bearish. You could argue in the last day, the close was a little bit higher than the low of the day, so there was a little bit of buying. Maybe that buying was towards the end of the day, and that could be a little bit promising. Let's have a look at the 5-minute chart for the Nikkei. Not a lot of buying, but the down or the selling had come to an end, looks like. In fact, the low was reached at 125. That's not right. That's local time. That's my time. Nikkei is not open at 125 because our time zones aren't that different. Not sure what that is. Okay, let's have a look at the Hang Seng. And yeah, nothing much happening with the Hang Seng. If you look at the weekly chart, it's actually in the downtrend. And I'm assuming that the DAX and the FTSE were down pretty big as well. The DAX was down about 4.1% for the week, and the FTSE down 1.3%. But if you look at the weekly FTSE, it's just going sideways. But it's been going sideways for about 2 months. So a fair bit of weakness in the markets around the world. That should translate to the Australian markets on Monday, which is tomorrow. I do expect a fairly big down day, another big down day. So I'm expecting maybe between 1 and 1.5% on open, and it could move towards 2% down. Maybe we might see it down by less than 1% if we do see a little bit of buying during the day, if someone thinks it is a buy the dip situation. So I have no idea which way it's going to go, but I do expect us to be in the red. Okay, so let's have a look at commodities. We start with gold, and gold you would think it should be okay. You should, and it does translate here. In fact, gold was up for the week, 2.3% for the week, and it closed at an all-time high. Now, when I say close at an all-time high, the closing price. So I'm looking at all the previous closing prices, and the price that closed in the week was an all-time high. We had seen the gold price higher in the past, but that was not the close. So at the close, gold bugs are probably happy right now. So no complaints when it comes to gold. And if you look at the daily chart as well, yeah, you can't say the same thing if you look at the daily chart. It did not close at an all-time high because a few days ago or 2 weeks ago, we did see it get a little bit higher. But daily chart, weekly chart don't look negative at all for gold. In fact, it looks positive. Can't say the same thing for silver. Now, there should be a positive relationship between gold and silver. There's not always. And in fact, silver looks a little bit more bearish than gold. And I always think that there's probably better plays in silver, but how do you play it? Do you play the commodity or do you play silver companies on the ASX or overseas? And there's not many around. Iron ore. I don't know what happened on iron ore the other day. What day was that? That was Tuesday, was it? Wednesday. Fell 4.5%. Not no, but that was a nice little support level where it was, the low on that day. Back above $100 though, so not sure what's happening in iron ore. The weekly chart just tells me there's no real trend in iron ore. It could go higher, it could go lower. I have no idea. You always hear in the news that like Goldman Sachs forecasting iron ore prices to hit $50 or $200 in the next year. And typically those sort of predictions are wrong. I would never, ever listen to those sort of predictions. And I do know some people do, but I would never listen to those sort of predictions. You know, funny enough, I don't really look at volume when I'm looking at commodities. But if you look at the volume with iron ore, it's actually increasing. I don't know if that's a signal, but I don't know if it means anything. I am looking at uranium, or Sprott physical uranium, which is a little bit different than uranium prices because this is not uranium price at $24, but uranium prices have fallen. Not as much as some of the uranium companies on the ASX. Most of the uranium companies on the ASX fell between 10 and as high as 20%. Pretty sure deep yellow fell about 18%. Let me just have a look. No, that's data 3, Michael. Jeez, data 3. And 18, 19%? Oh, 12%. Something fell. I'm pretty sure some uranium company fell about 18, 19%. One of the big ones. So let's go to my uranium watch list. Was deep yellow. It says 19.23% here. Oh, that's the weekly. I was on the weekly chart. So weekly chart says down 12%. Daily chart shows down 19%. That's why I was certain deep yellow was down 19%. Yeah, deep yellow down 19%. In fact, all the uranium companies' charts look really weak right now. And that's on the back of, I think I talked about this on maybe Friday's video. It would have been Friday's video. That big mine, that biggest uranium mine, is it Kazakhstan? I'm just assuming it's Kazakhstan because that tends to be the biggest miner or uranium miner. Kazakhstan uranium. 12% of the world's uranium resources. What? I'm looking for the Kazatomprom. I'm pretty sure that's the mining company or the uranium miner that has increased or is seeking to increase production, and that's why uranium companies fell a fair bit. We didn't really see that in the Sprott, did we? Let's go back to that chart. Didn't really see any significant decrease in the Sprott, but it has moved into a downtrend. Yeah, uranium is now in a downtrend according to the Sprott physical uranium. And if you look at the individual uranium companies' charts on the ASX, they're all in downtrends and big downtrends at that. Fairly significant shift in sentiment in those companies in the past few months. Oil down to $74.11. And this won't be translated to the amount of money you pay at your local petrol pump because they'll be still gouging us. They want to gouge us as much as possible. And there should be inquiry into why petrol prices are so high, because petrol prices right now at $74, not much higher, in fact, lower than at times during the past 20 years. And yet oil prices, petrol prices are significantly higher. There's probably reasons behind that, but maybe even justifiable reasons, but we need explanation. Why are we paying so much more for petrol when oil prices haven't increased at all? I'd love to see them explain it. And I do know the production costs have increased, that sort of thing. Production costs, all the costs have increased. Yeah, so I do know why, but I want them to explain it. Natural gas, anything happening here? No. Oh, that is a weekly. I was looking at the weekly. I was looking at the daily. I thought it was a weekly. Weekly, no. Lithium, someone mentioned, I did see a tweet the other day that lithium carbonate is at all-time lows. I thought it couldn't go any lower, but it's still decreasing. Copper had a really bad day on the Thursday, was it? Was it the Thursday? Yeah, it would have been the Thursday. Yeah, down at 2.25% after a good day the previous day, just because a bit of fear in the market about the economies, and of course, Dr. Copper. It's a sort of a proxy for the state of the economy. And if you do look at this chart, you'd say, well, the economy is in trouble right now because the price or the copper chart starting to look fairly weak. Coal, as always, it's almost on the cusp of breaking out just based off this. And I suppose all the other commodities look pretty bad. That's tin. Nickel looks, well, you've got to have to draw the line for nickel, but it looks, oh, nice little bounce though. Nice little bounce in nickel, but it's a big collapse from the highs they just saw back in May. And let's have a look at palladium. Why not? Palladium. Nothing to rejoice for palladium bugs or bulls or whatever you want to call them. And cocoa. Let's have a look at cocoa. Yeah, cocoa. All right, so let's have a look at Bitcoin, Ethereum, and also bonds before we move to some individual stocks charts. And I have a thing about seven ASX companies and 3 companies listed on the New York Stock Exchange or the Nasdaq. And I want to show, 4, in fact, no, 3, yeah, 3. So before we do that, let's have a look at Bitcoin. What's happening with cryptocurrency? Trading in a channel. It's going sideways. That's definitely true for Bitcoin. Is it true for Ethereum? Yeah, I'd actually say it is sort of true for the Ethereum, although the highs are getting lower. The major highs getting lower. That can be a bearish sign. This could be turning into one of those descending triangles, maybe ascending triangles. Let's have a look. Would it be I'm going to call it descending triangles, and I'm pretty sure they're bearish. Descending triangle. Yeah, descending. There it is. So you see the highs getting lower, but the base is like horizontal. So do we see that with Ethereum? Yeah, we do actually, don't we? Yeah, actually, yeah, we actually absolutely see that. So you saw that these highs are getting lower. It's not a perfect downtrend, but the base is almost perfect. It's a beautiful base. Somewhere there. So it's starting to look like a descending triangle, and I'm pretty sure it's bearish. Let me have a look. Let me verify that. Is a descending triangle bullish? No, that's a trick question. A regular descending triangle pattern is commonly considered a bearish chart pattern or a continuation pattern. I could be completely wrong because I'm not expert in these, but I do know patterns, some patterns. I know a lot of patterns, but I'm not an expert on these patterns. You can spot the descending triangle reversal pattern at the peak of a rally. This pattern starts to take shape as volume decreases and the stock fails to reach new highs. So maybe also look at volume. Volume is decreasing during this period. There's a little pickup here in May, but that was it. Volume has decreased. Yeah, they're right. Whoever wrote that? 5 pacer. Okay, so let's have a look at bonds, and you're going to see something really interesting with bonds, an absolute collapse. Yep, there it is, an absolute collapse. On Friday, bonds fell 4%. In fact, during the week, bonds probably fell about 8, I'm going to say 7%. Let's have a look, 7%? 7.7%. I was going to say 8%. So would have been more right if I said 8%. So that's a pretty big sell-off in bonds. So you really want to be owning bonds right now because bonds, not the bond yields, but bond prices have gone up significantly in the last week. You can see that by the TLT ETF, which you'd see the complete opposite because don't forget, bond yields and bond prices are inversely related. If bond yields are going down, bond prices are going up. So you want to be owning bonds when yields are going down. And you just see that with this particular ETF. In price of this particular ETF on Friday, or it says Monday, the 29th of July. Is that a weekly? Oh, that's a weekly. Let's have a look at the daily. And yeah, this particular ETF on Friday, massive volume coming in, rose 3.1%. In fact, you could even say this is a breakout. In fact, I'm just going to actually do this. Just adjust it, auto fit, there it goes. You can see it much better now. I could even say this is a potential breakout for the TLT. And the reason I'm saying it's a breakout, it's a really good volume coming in. There's no financial news. Well, sort of there is. There is news flow justifying this particular breakout at about 3-month high. Yeah, it's about a 6-month high, in fact. Breakout for the TLT. The 20-plus year Treasury Bond ETF. Possibly a really good play. Yeah. Okay, so let's get to some individual companies' charts. Let's start with Domino's Pizza. The main reason is fantastic. I did talk about this company in my answer reply video, and someone did mention about 17 hours ago. So on Saturday, why DMP down 10% on no news? Less pizza upon recession. I did look for some news flow. There was no news at all from Domino's Pizza. So all I did was Domino's Pizza stock, which could be America because Domino's is also listed in America, but they own different parts of the world. Their stores, different parts of the world. So you could see New York Stock Exchange DPZ. I'm going to say ASX maybe. And Actually, if you go here, yeah, down 10%. This is from Motley Fool Australia. Down 10% in a week. A Domino's Pizza shares a bargain buy. Well, you could have written that as down 10% in one day because that 10% was ill in one day. Now, my little problem with this article, I actually did read this. My one problem with this article is they mention, yet the stock still trades at a price earnings ratio of 44.1, meaning investors have to spend blah, blah, blah. But that PE ratio is on the back of significant depression or decrease in earnings. And I think there can be an argument that those earnings could significantly rebound next year or the year after, which would mean that PE ratio is significantly lower than that. That's just me looking at the historical earnings. So we did see Domino's Pizza's earnings drop significantly in 1 year. Will they remain that low? Will they remain repressed? That's a possibility. But just don't look at 1 year's earnings and say, well, the P ratio is 44, because you can be fooled if you do that. Either way, by the way, some company can have inflated earnings 1 year, and you could look at the P ratio and go, oh, it's 9. That's really low. And then the next year, the earnings are significantly lower. And it's not a true P ratio. That has happened to me in the past when I was a new investor. I remember looking at this one company. I went, oh, that looks like a really good PE ratio. This company's okay. I'm going to buy some shares in this company. And then I dug a little bit deeper, and those inflation or those earnings were inflated because the company, if I remember correctly, this was well over 10 years ago, because the company, I can't remember what the company was called. The company either revalued property. No, it wouldn't have been revalued property. I think they sold something. And on the sale, they made a profit on the sale, and that profit, of course, goes to earnings. So they made this one-off increase in profit, or this one-off profit, which exaggerated the profits for that 1 year. So it made their P ratio look really low. And I would call myself an inexperienced investor, and I did not realize that. I just saw the P ratio and went, oh, that looks pretty good. And I learned my lesson. So anyway, Domino's Pizza fell 9% on 9.24% on Friday. I thought, surely there must be news for this type of drop. What could have happened is there could have been a broking service who put a sell out for Domino's Pizza. There could have been a downgrade, that sort of thing. Or maybe there is some rumors. I didn't see any rumors. That's why I Googled it. I just wanted to see if there was any rumors out there in regards to Domino's Pizza. Did not see anything. So this could be just noise. And the share price of Domino's Pizza has fallen by $30. The last time the share price of this company was this low was 10 years ago, if I remember correctly. Last time the share price of this company was this low was, let's have a look, $30. It broke $30. It broke $30 in February 2015, almost 10 years ago. And that chart back then looks beautiful. And this is another perfect example of don't fall in love with a company. Perfect example. Okay, so that's Domino's Pizza. Resmed. I did a tweet on Resmed. In fact, it's my most liked tweet. I've had 10 likes. 10 likes. I'll show you my tweet because it tells everything. Let's have a look. Let's have a look at my tweet. How do we find my tweet? Warren Buffett's Berkshire Hathaway sold nearly half its stake in Apple. Buffett is running to the exits. He sees what's coming. I'm telling you, Twitter is really pessimistic. But maybe he just thinks Apple is expensive. And yeah, but he's building up his cash, and that's actually a good sign. Yeah, that's a good sign. Anyway, what was I doing? I'm going to find that tweet. Here it is. Here's my tweet. So Resmed. So remember, Resmed released their quarterly results on, was it Friday morning? And the share price of Resmed on the ASX fell 1.8%. I didn't understand it. It didn't make sense. It was really good results because the margins had increased, a really nice increase in margins. And Resmed is traded on the New York Stock Exchange. What was the share price? What was the movement of the share price on the New York Stock Exchange for Resmed? Up 4.2% when the overall market was down 2%. So I just couldn't believe that the Americans appreciated their company's quarterly report more than Australians. Be better, Australia. Yeah, and yeah, 10 likes. So whoever liked it. Only 189 views, 10 likes. Got to appreciate your wins. Appreciate your wins. Anyway, so this is Resmed. Share price fell on Friday. I would assume it's going to increase on Monday because the Australian investors are going to go, wait, share price increased in America by 4%. What did we get wrong? At one point on Friday, the American or the Australians were right because the share price was up, but they didn't last very long. And it looks like right on 11:45, there was a big sell. You can see this is a 5-minute chart. Over a 10-minute period, the share price dropped from 32.60 down to 31.50. I would say that was a fund manager getting out. And that actually did decrease the sentiment in the company and the share price down. So it could have been just one fund manager selling. Just waiting. I don't know why they would sell based off this quarterly report. So whoever did sell, if fund manager did sell, I would take my funds out of that fund manager straight away. I'm being a little bit biased. I'm a Resmed shareholder right now, and this is actually one company I could consider taking profits because I do have a big holding, and I'm in okay profits with this company right now. Okay, WA1 Resources, a company I've never owned, but I have been following this company a little bit more because the share price has been so volatile lately. Let's have a look at the daily chart. Beautiful uptrend, but is the uptrend coming to an end? So the uptrend or the share price of this company broke out way back in October 2022, which is not that long ago. And this is a beautiful breakout. What can you say? This is exactly what I'm looking for. Of course, I completely missed this one because I wasn't doing these sort of screeners back then. The share price on the 26th of October for WA1 Resources rose 418% in one day. Now, at the end of this day, you could have bought this company's shares at 70 cents. And a lot of people would have been saying, you're crazy. It rose 400%. You've missed it. You've missed the boat. You could have bought at 70 cents. The share price right now is $15. So what's that? That's a 20 bagger. So don't be scared when a company's share price rallies 418% in one day. There's a reason behind it. And you could miss out on massive baggers if you're scared off by that. But the reason I wanted to show you WA1 Resources is just where the share price is right now. This 15 level, around 15 level, we'll call it, is a really important level for this company's share price because the share price of this company got up to this level back in January and then pulled back. So that was a resistance level. And then the share price pulled through this level on a little bit of strength. It took a little bit of time to get through, like 3 days, which is a little bit of time, but it moved through and then just kept on rising. Now, what happened? There was a little bit of selling coming in May, and what's the month after May? June. Share price moved all the way back down to $15. What happened when it hit $15? It bounced, and wow, that bounced hard. So straight away, we know traders understand that $15 is support level for this company. It was resistance. When resistance is broken, it becomes support. Nice little bounce. If you actually played this bounce, and I actually was looking or seeing, I was seeing if it was going to bounce, and it bounced straight to plan. And the share price went from $15 back up to $21, $22. It's a really good bounce, fairly short period of time. And look where the share price is right now. And in fact, over the past 8 to 9 trading days, the share price has just been sort of skimming along the top of this support level. So instead of bouncing, it's just moving sideways above it, which tells me that the traders who really played this trade in June on this first bounce, they are being met by sellers or by the bears. Wouldn't be surprised to see the share price fall below $15. And that would be a bearish signal. That would be a break of the support. The other interesting thing is the last high was lower than the major high we saw, this company saw back in or on the 20th of May. So a lower high for WA1 Resources. Don't know why I have difficulty saying the name. So maybe, just maybe, the end in the uptrend has come for this company. Just a possibility. Appen. Okay, Appen. Have to include Appen. What a stellar run during the week. Share price rallied probably 60 to 70%. Let's have a look. Share price increased 73.9% for the week on the back of a pretty good, well, actually, no, I would say it rallied on the back of an okay pennies 4C. Didn't make me jump up and down with glee, although I wouldn't be doing that because I'm not a shareholder. But the market liked it. Two things that are interesting about this reaction from the market. So the share price is not only the share price rallied on that day when they released their pennies 4C, it rallied the next day as well. But a couple of interesting things. When the share price gets above about 75 cents, there is selling. You can see the selling in the last 3 days. There is a shadow, so above the main body, which is telling me the share price gets up to a certain level and the sellers come in. The sellers come in, selling. The sellers could be those who bought sort of in this area here, this period here, back in March and April. Maybe some traders got stuck. They thought the share price of Appen was going to go on a run, and of course they bought at the wrong time or at the highs or near the highs, and they got stuck with the shares. They just didn't want to sell for loss, and they said to themselves, as soon as Appen share price gets back up to the level I bought, I will sell. And that could be a little bit of pressure on the share price or resistance right now. But look at the volume, massive volume. That's the volume I like to see. Now, if we see a little bit of lower selling pressure, there is potential Appen share price could go on a run. But yeah, I didn't think the Appendix 4C really deserved that sort of reaction. But who am I to argue the market? The market loved it. Possibly there is more day traders in this right now than I would like, but I can't ignore this sort of price and volume action, no matter the company. Really good price and volume action. So definitely have this on my watch list. Appen. I think I have it on my watch list. I don't. So I'm going to put it on right now. Okay, Sol Pattinson. I'd say this is a fairly popular owned company among retail investors. I assume it because this company is renowned for continually increasing their dividends. But if you do look at the weekly chart, share price is at an important level. Share price has struggled to get above $36 over the past year. And share price of Sol Pattinson is right on this level as we speak. This is a company I have owned in the past, but I'm not a shareholder right now. I understand why, fully see why people would own this company, because I do think they are a good operator. So this is a diversified, sort of like a conglomerate. They own lots of different companies, that sort of thing. I don't like some of the companies they own, though. Some of the bigger companies they own. I'm not a big fan of New Hope. I prefer some of the other coal companies. I'm not a big fan of TPG. And what else? What's another big company they own? Those are really the two big companies they own. I'm trying to think of some of the other ones. Sol Pattinson companies owned. Brickwork. Oh, I'm going to forget Brickworks. Yeah, but New Hope and TPG are definitely the biggest. Oh, actually, no. Tuas is now the biggest holding. Well, I'm trading Tuas, so I don't really need to be in Sol Pattinson because I do or am trading Tuas, but maybe that's why Sol Pattinson is doing quite well. Because, yeah, New Hope, meh. TPG Telecom, meh. Brickworks, yes. Actually, I'm a fan of Brickworks. What else do they own? Let's have a look to see if they own anything else here. No, they don't list them here. But anyway, yeah, this is not a video on Sol Pattinson. But, yeah, the two of the biggest three holdings I'm not a big fan of, New Hope and TPG. I do like Tuas, but Tuas is not profitable. Pretty sure it's not profitable. But anyway, the big thing about Sol Pattinson is it's at a resistance level. And I wouldn't be surprised to see a little bit of weakness in this company moving forward, particularly if we see overall weakness in the market. But definitely a company to put on your watch list if you don't own shares in this company, because if you look at the monthly chart, you're going to see a chart of a high quality company. This is the chart of a high quality company. This goes back to 1990. Share price of this company was below $1. Now it's $36. This is the chart of a high quality company. This also tells me whenever you see the monthly share price get towards the 100-week or 100-month moving average, time to buy. So it happened in March 2008, April 2009, happened in January 2015, got fairly close in August 2015, definitely during the COVID-19 financial panic. Got very close in June 2022. Remember that weakness in the market, and the share price of WHSP Patterson got very close to that buy point, sort of like a no-brainer buy when the share price of this company gets to that level. Anyway, so it's WHSP Patterson. Company I don't really follow at all, National Storage. So it's like a REIT. Well, it's not like a REIT, it is a REIT. And I'm wondering, is this the sort of REIT that's sort of a no-brainer? Well, not a no-brainer, but if I had to choose REITs, this sort of REIT, National Storage, I don't see why this company will ever get affected. Everyone needs to store, well, maybe not everyone needs to store stuff, but I have stored stuff in places like this before for short periods of time. Anyway, what drew me to this particular chart is the share price. Looks like it could be close to breaking out. Very close to breaking out. I could include Dexus DXC. This chart, for some reason, was an absolutely stellar, or this company was an absolutely stellar performer on Friday. And I just went, wow, this chart looks really interesting. But I do talk about this REIT a little bit more than other REITs. So I thought I'd look at a different REIT, or show you a different REIT, a National Storage REIT, because this looks like it's trying to break out. Gets to about 250, it could be breaking out. Although, to be fair, with REITs, it's all about value. What's the discount to the NTA? And I have no idea about National Storage, but this could be just a trade. Let's have a look at the weekly chart. And yeah, the share price hasn't decreased all that much. So there's still, I think there's a little bit of strength in this company. It wouldn't be surprising to see this company trading not much of a discount to NTA, possibly even at a premium to NTA. In fact, let's have a look. NSR, they should have, hopefully, oh, jeez. Hopefully, they released a monthly thing. They haven't released their results yet. They don't release monthly stuff. But not. So the last the half-year results. I'm just going to see what their NTA is. So share price of this company is $2.46, and the NTA at $2.48. Yeah, so this company is not trading at a discount at all, which probably tells me the market's already thinking what I'm thinking. There's probably a strong REIT. And even the chart looks like that as well. A nice increase in the share price over time. So you get nice dividend. I'm assuming there's a nice dividend yield. Let's have a look. 5% maybe, 4.47%. So you get capital growth, a little bit of capital growth, and also a nice REIT, a nice dividend. Yeah, if I had to choose a REIT, possibly this one, I don't know. And Moneyme, this one definitely popped up on my radar on Friday because, well, not because of the weekly chart, but if you look at the daily chart and just zoom in a bit, share price, zoomed high up. Share price rose 15.5% on Friday. This was after, I suppose, in hindsight, a pretty good trading update on Thursday. So I'm pretty sure that was on Thursday. 3, 2, 1. Yep. That was on Thursday. Financial year or fourth quarter 24 trading update. Strong growth and strong loan performance. Not as much a reaction on the Thursday. Share price was up 9%, but then on the Friday, even better response from the market. Share price got as high as 10.5 cents, and 10 cents is a natural resistance level. It's also true for this company because of what happened way back in January of this year. Share price tried to get above 10 cents 5 consecutive days and failed. Share price then slipped back, less enthusiasm in this company, and the share price fell all the way down to a low of 6 cents back in May. And maybe this is a breakout on the cusp of happening for Moneyme. I'd like to see 10 cents broken. I'd like to see the share price get above 10 cents, and it could happen soon. I'd like to see a little bit bigger volume coming in, but it's on the precipice, I think, of breaking out. It may not happen, and the share price could slip back down to 6 cents over the next 4 or 5 months. It could happen. Okay, so that's the ASX companies. Now on to 3. Which order am I going to do this in? I'm going to do Snapchat first. I've mentioned a few times that I find the fickleness of the American markets a little bit, what's a good word there? The fickleness a little bit, I wouldn't say frustrating, but not confusing. I just don't like it. And Snapchat is sort of the poster child. I saw this chart and went, yeah, this is the poster child of what I don't like about the American markets. They're just so fickle and they react so ridiculously on a quarter results. And we have seen this happen with Snap 3 times in the past year. Well, actually, the past 3 quarters. We saw it in February, we saw it in April, and we saw it in August. So one of these was not a quarter result, so it would have been August, May, and February. Oh no, they are. No. So in February, share price dropped 34.6% on the back of their quarter results. The other thing I should mention is there was a lot of chatter about this company, share price dropping 50% in a short period of time. And I looked at the chart and went, well, yeah, it's dropped 50% in a short period of time, but it actually has risen since October last year. It's just risen. It's just because it's just been so stupid. Maybe it's stupid. It's been so volatile on the back of quarterly results. So in February, share price dropped 34%. And then in April, share price rose 27.6%. And it kept on rising. And then share price on Friday dropped 26.9%. So I can almost guarantee you when they release their next quarter results, share price might go up 20%, 30%, or it might drop 20 or 30%. Now, in saying all that, Megaport MP1 showed the same characteristics as Snapchat, not to this extent or this extreme, but this is one of the reasons why I don't like the American markets. They release quarterly results and you just see ridiculous reactions, but sometimes you can take advantage, and I've done exactly that. When I've seen the share price of a company I like for the longer term, and then I see the share price drop 10, 15%, I have bought in on those days, and a lot of times the share price will then go on a run. So that's one thing I don't like about American markets, just the fickleness. So that's Snapchat, down 26.9%. Onto a company I've never heard of before, and this actually popped up on my radar because the chart looks pretty good. Looks like it's breaking out. Looks like it's moving into an uptrend. And this is a company called McCormick and Company. 10 points if you guess what this company does. Some of you might guess, but I am not a spices man. Well, I like spices, but I don't really look at who produces spices. I just look at what spice is this? Oh, that's cinnamon. I've got to buy that, and I don't have any idea who produces spices. This is a spice manufacturer. You don't manufacture spice. You sell. What do they call them? Engages in the manufacturing, marketing, and distribution of spices, seasoning mixes, condiments, and other flavorful products to retail outlets. And we know through history that spices are a big thing. What was the very first company traded in the world? Dutch East India Company. And one of the things they traded was spices. What was it called? Dutch East India Company. This was the very first traded company in Netherlands, 1600 something. It was founded in 1602, and I'm pretty sure it was started trading in just after it was founded. In fact, it says here, in one of the first joint stock companies in the world. I would say it's the first. I could be a little bit wrong on that, but I would say it's the first. And one of the things they did do was trade spices. And here it is, right here. Having been set up in 1602 to profit from the Malucan spice trade. So for those who don't know history, spice trade was massive because a lot of spices we just take for granted weren't available. They were grown on the other side of the world. And once the spice trade happened, all these spices, these wonderful, wonderful spices became available. And some of these spices were really expensive. And, only the rich could probably afford them. Anyway, so that's this. They've mentioned Australia here. An Australian Vinter has used it. Okay. Anyway, that's the Dutch East India Company and spices. And McCormick and Company are into spices. Next time I go actually to the Woolworths, I'm going to have a look to see the spice racks and see if McCormick produces or sells spices available in Australia. I have no idea. But anyway, the main point about this chart is it looks pretty good. share price on Friday was up. Actually, share price of this company on Thursday and Friday was up both days. That shows strength. When the share price of a company is up 2 days in a row, when the overall market is down 10% or so, maybe not that much, that's strength. So people are liking this company for some reason. I don't know why, but the chart is telling me a story. So charts still tell stories. Look at the weekly chart. It looks pretty ugly lately. Look at the monthly chart. The monthly chart tells you a story. And what story is that? If you go through, yeah, it shows you this company could be a high quality company. I have no idea, but yeah. So that's McCormick and Company. Company I never heard of before. I looked at the chart and went, oh, this looks interesting. And then I looked at what they do and I went, spices. And I couldn't forget Intel. So I've already showed you Snapchat. Share price down 26.93%. Intel was down 26.1%. If we started the daily chart, whoa, daily chart looks really bad. Daily chart looks pretty bad. Share price of this company has dropped from $50 to $21 since the start of 2024. The share price high was a few days before the start of the new year. And yeah, the share price has dropped significantly. I was actually looking at this company back here thinking, oh, they make chips. Maybe this is a good buy. Maybe not is the answer to that. Well, actually, the answer to that is not maybe not. The answer to that is no. An affirmative no. Absolute no. But the share price of Intel is now at $21.48. Is this an opportunity? So look at the weekly chart. Is there any support at this level? Well, share price of Intel down 31% in 1 week. Fell through support on strength. That support level was the lows this company experienced in 2022. So straight through that support level. Let's have a look at the monthly chart. When's the last time share price of this company was this low, like $20? Well, the low during the COVID financial panic was here. The low during the COVID-19 financial panic was actually $43. So the share price has halved from the lows in the COVID-19 financial panic. I forgot this is a monthly chart. So the share price, or the last time share price of this company was $20 was back in 2014. Actually, no, 2013. So this company is now at almost a 11 and a half year low. Yes, 11 and a half year low. Is there any value in this company? Possibly. Now, based off this chart, would you describe Intel as a high quality company? I'd probably say no. No. Although this was during the tech bubble, and without doubt, Intel's price probably got way overvalued. So if you actually smooth that out, share price probably has been in a long-term uptrend. Yeah, I'm going to say that, yeah. I'll say this is a potential high-quality company, but troubled times for Intel. Okay, I think that's it. That's all the companies I want to talk about. All the indices, all the other stuff, bonds and Bitcoin and commodities. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Have a good weekend. Have a good week. And don't get too wound up if the market drops by a lot on a Monday. Keep your emotions in check. That's all for today's video. Have a good day. Bye.